This is Rod Kusin, Spooman for Risk. It is Wednesday, December 15th, 2010. All times on the chart are Central Standard Time. We're going to take a nice look at all of the strategies today. They all did pretty well. But we're first going to talk about the retracement lines, 90% accurate today. And here they are. Here are the retracements that are calculated based upon specific characteristics in the ESINX premium data feed set to 100 ticks. The magenta horizontal lines are low retracements, the white are upper retracements. And as you can see, all of our retracements, with the exception of 4, were hit. With all of the retracements that we actually had, that's a 90% accuracy rate. Now, the benefit of having this, of course, is that as the market starts to move up and leaves these lower retracements behind, with a very high probability that these are going to be hit, all we need to do is look for an opportunity to short the market. And you'll see where our strategies shorted a little later on. And then as we get down here into the lows with retracements above the market, an opportunity to go long would make for good profits as we go up to the closest retracements, both of which were hit precisely. And we'll show you where we went long in just a few minutes. So how we can use these retracement lines are somewhat subjective, but I like to personally use them as profit targets because I have a very high probability that these are going to be hit. When the market moves away from these lines, I know that I can take a trade with a very, very good probability that that trade is going to make money when I use these as targets. So as an example, normally I don't want to take a short trade until I have a white line, because I know that once I have the white line, I've got a target there where I can expect, well, the market should go back up, and once it does, then I'll look for an opportunity to take a short. Similarly, when I'm looking to take a long trade, it makes good sense to wait for the retracement, the lower retracement, to get hit before going long. And if I don't have a retracement line, I increase the possibility that the trade isn't going to work. So really, it's a fantastic way of trading with very, very high accuracy. We hear people talking all the time about, well, where's the market going to go? Well, we can tell you where it's going to go. Now, a few other things. What we teach in our course has to do with overall daily pattern. And today we had a very high probability short trade that would form. And we run calculations on the premium, again, that help us to know in advance what the bias, if you will, is during the day. Now, unlike some sources where the bias doesn't change, our strategy system allows the bias to change based upon real-time calculations. So we had a short bias as we're moving up to the high here, and later on we had a long bias, and then a short bias again, and then a long bias, and then a short bias. So we changed the bias at various times during the day. And I shouldn't say we changed it. The computer calculations will actually tell us using an audible announcement as well as a pop-up on the screen what the bias is at any particular moment. Now, it doesn't tell us when to take a trade. It just gives us an overall the most profitable trades based upon the current bias. So let's take a look now at a few examples of our trades. Oh, actually, before we do that, with regard to the bias, knowing that the bias today was short, here's something that can be very, very useful information. Now, look at where the low of the morning was. The low of the morning was basically right at the open. We run up and we go into this short. Now, once we've exceeded the low of the morning, the rest of the day is a walk in the park. And the reason for that is because we already know the approximate time when the low of the day will hit. We teach in the course how to know that. So in this particular case, once we've gone lower than the low of the morning, which happened right in here, just before noon, as we retraced back up here, we already knew we're going to drop below this low right in here. We already knew that. So taking a short trade in here and holding it until we hit a new low for the day, again, a walk in the park. But we even knew more specifically about what time that would occur. And we teach that in the course. We were discussing in our trading room that about 2 o'clock thereafter, a little bit after 2 o'clock, we would expect the low of the day. Well, as it turned out, the low of the day just came right at 1 minute before 2. That was a bit surprising. But in any case, that's approximately where we were expecting to see the low. When we hit this low, again, one of our traders in our trading room asked, well, are we expecting a new low? And I said, well, yeah, because given when that low occurred, which was right around 1:30, that was too early. We expected another low that would take place. And that's based on pattern, and we teach you how to do that in our course. All right, now we'll go ahead and take a look at some of the trades. We're going to first of all look at our trend setting. Our strategy has 3 primary settings. One we refer to as the trend, one we refer to as a pivot, another is a divergent setting. And they're all built into the same strategy, but what we do is we set up workspaces where only those particular settings are firing off trades. We'll start off with the trend. Now here we have a variety of different settings that we use for taking these trades. And they're all built into the chart. But these are automated trades. In as much as we state very clearly on our website that this is an automated system, some people still wonder, are we automated? Well, yes, these are automated trades. So the first set of long trades happens right after this pullback. Now, normally we are not going to get a trend trade that's right at a pivot. We wait for that pivot to take place, and then we go long. So we're not going to look at a long trade right at the bottom of a move. The trend setting will always delay that. Now, there's some downside to that, but that's the way it's currently set up. So our first set of long trades in here, and we set up a very reasonable profit target for this, and they get hit. Now we didn't use, by the way, we didn't use any of our retracement lines as profit targets. We were just using a pre-calculated number of ticks, and that gets hit. Now, another thing that we have to watch for is that as we move higher and higher and higher, the trend setting, the closer it gets to an overbought condition, becomes something that we want to be very careful about. We usually aren't going to take trades once we're getting very close to an overbought condition. But this is where they fired off. And as you can see, we were already overbought, getting ready to go the other way. So let's now look at the trend short. And this is kind of interesting because when we saw the short trades on the trend starting to show up, we knew that any long trades no longer had a strong probability of working. So right in here, we had our first set of short trend trades. Then we get those long trades in here, and then the short trades showing up again. So we knew that that move was pretty much over when we start going back and forth between short and long. The shorts are going to win out, and all we had to do is really wait for a retracement to get hit, such as that white line right up in here. Wait for that to get hit. Then this short right in here becomes real high probability. So that's another factor. When we have these high probability retracements, taking trades such as these short trades right in here doesn't make a lot of good sense. And we have a method by which we can prevent our trades from taking place when they are in close proximity to a retracement line. But we didn't use that for the sake of this demo. So as you can see, we have this retracement in here. Down the market goes. This retracement, or pardon me, this short signal here would have taken place regardless because there was no retracement in existence at the time that the short trade took place. But as the market moves up and we are left with this retracement right in here and we get the short trade, that doesn't make as good a sense because the high probability is that the market will go up and retrace to that price. Once it does, then a short signal makes excellent sense. And there's a simple way that we can set up the strategy so that it will always observe those retracements. So here we start getting short trades again, then here, right before it begins to tank, and down she goes. We get a few premature short signals right in here that don't go anywhere, but then right again at the top here, boom, down she goes to the low of the day. And what's making this a little hard to see is that we are hitting all these profit targets, so it's a little hard to make heads or tails out of that section of the chart. And here they are again. We just spread that out a little bit more so you could see. All right, so that's both the long and the short trend settings in the strategy. Now let's look at the pivot setting. This is the pivot setting. And as you can see, we have no short trades showing up until the high hits. That's how accurate the strategy can be. Comes in here, hits the high, shorts it. Granted, we expect that retracement to take place, so we want to be careful that it doesn't continue on up. But there's the short. That's the only place that it's shorted. And then comes down, and we start to get automated long trades down here. Now again, these are probably well, we know that they're early because of the overall pattern. We should be continuing to move down, but we didn't take pattern into consideration. We just let the strategy look for conditions that it would ordinarily provide a trade. So these long trades in here don't go anywhere, but plenty of opportunity to pull the trade as the market begins to come back down. Then we do get a long trade right in here. Now that doesn't make a lot of sense to take a long trade right in there, because the trend, as we just looked at the trend trade was short at that particular time. But nevertheless, the conditions for a long trade did exist at that moment. Then the next longs show up right here at the bottom, right at the at a particularly good time. They hit a profit target, and then we get another short trade right at the top here. So that worked out quite nicely using the pivot setting. Now we won't go into the divergence, because the divergence pretty much looks exactly like the pivot does. I'll just briefly show you this. Here the pivot setting takes the short trade just a little bit earlier than the divergence setting takes the short trade just a little bit earlier than the pivot. But during the latter part of the afternoon, we had no further trades on that setting. And now a quick look at the performance reports. And then one last one for the shorts. I think that's right down here. Yeah. Okay. All right, so there you have it. One of the key factors that we watch in the what we refer to as the premium strategy is the premium itself. And we run specific calculations on the premium so that we know approximately where the premium needs to be in order to pull the best long and short trades. And we run some proprietary indicators on the premium as well to help us to see when those trades are most likely going to develop. And that's why we get some very, very accurate trades, because we're using an indicator that very few people know anything about, let alone how to read it. But that's the premium. And we use in particular the ESINX feed with TradeStation. Now there's some other market indicators that we also like to watch. This includes the tick US, $TIKUS, which is a compilation of all of the tick data on all of the US exchanges. and we run that down at about a 10 tick level. Then we run calculations on the tick to tell us approximately what the price of the tick should be at the time when the most probable trades will take place. And that's why we have these two horizontal lines on the tick. We do the same thing when it comes to, let's get that data feed here. Pardon me, we do the same thing on the dollar sign tick. We run specific calculations on the tick to determine at what price the market is most likely going to reverse direction. So unlike some who just look for a major overbought or oversold level like 800 or negative 800, we go beyond that. We run calculations to see where the best trades are taking place and what the price of the tick was at that time. So there's a lot of things that go into our strategy, but it's all automated, and we teach you, of course, how to go about setting these things up, and then basically it's just a matter of managing the trade. So we invite you to come to our website, RSKsys.com, ask for a demo. This is Rod Kusanen, Spooman for Risk.